Protesters marched in the Guinean capital in the thousands, angry at the government's decision to hike fuel prices by 25%.
The cost of fuel should be 80 US cents. 1 cent on top of that is 1 cent too much.
They say the proposed hikes will add to sharp increases in the cost of living, and they're not earning enough to survive. There were similar demonstrations in Haiti last week, and violence there drove authorities to cancel double-digit hikes to petrol, diesel, and kerosene prices. If Guinean protesters don't achieve the same outcome, there could be more unrest.
The economic sector is totally paralyzed, with devastating consequences. Life in the coming days will be difficult and painful for many who are already suffering as a result of the hike in fuel price.
Guinea and Haiti are a few of many poor oil-importing countries forced to do away with fuel subsidies put in place when oil prices were at $40 a barrel. Now they've risen 75% to $70 a barrel. The International Energy Agency has echoed the concerns of the protesters.
Higher prices are prolonging the fears of consumers everywhere that their economies will be damaged. In turn, this could have a marked impact on oil demand growth.
At the same time, the global energy watchdog is forecasting a tighter market in the coming months due to supply disruptions in Venezuela, Iran, and Canada. The possibility of less oil on the market caused a rally in Brent crude prices on Thursday, paring losses from their sharpest one-day drop in 2 years. Standing in the way of a continued rally is the biggest OPEC and non-OPEC exporters. Rising oil production from Saudi Arabia and Russia in place of Iranian crude could be a much-needed reprieve for poor oil importers. Laila Humairah, TRT World.
Joining me now for more on the crude markets is David Elmes. He's a professor at the Warwick Business School. David, great to have you on the show. We're seeing quite a lot of volatility in oil prices right now. Is that because the balance between supply and demand on the global stage is actually very finely poised?
It is quite finely poised, and if you like, the list of things that influences it one way or another has got a bit long. So your report mentioned the issues about supply from Venezuela. There's shut-ins in Libya. The question is how much sanctions are going to affect supply from Iran. And that sort of list of constraints gets longer. You have things like shutdowns in places like Canada and the North Sea. And even when there was a strike of some workers in a particular part of Norway, that influenced the price. So people are generally just a bit jittery on the long list of things that are influencing supply. But it's also that things are not just about supply and demand. It's also the economic and the political situation that we find ourselves in. So the sanctions issue is obviously a political issue. The potential of trade disputes around the world are also raising concerns that would disrupt the global markets for oil and other energy products. So it's that combination of, if you like, a longer list of issues on supply and demand, and bigger issues on the politics and economics.
Right, David. So all of that considered, where do you see prices going over the next 12 months?
So if you look back a year, you say prices have gone up from about sort of 50 to 75. And in 75, you're at the range where a lot of the oil producing companies have an element of comfort in terms of their ability to pay for the social programs that their oil income pays for. So if the sum drops a lot, then they're worried that more production will start coming in from other countries. So it's this issue of the price is as much a political issue as it is a supply and demand issue, and probably it may not go much higher than 75. But on the other hand, it won't drop too low either, because the producing countries rely on this income to maintain their economies.
Right. The US shale producers were supposed to be the ones that made all the difference, that they could come on pretty quickly as prices go up. We haven't seen that happen this time around because of some supply bottlenecks in the US. Do you see that situation resolving itself, and could the shale producers once again come on strong?
So the question is, when you've got a supply constraint, it's usually not particularly quick to fix, because often it's about having to build whole new pipelines, and those take a lot of time and money, and then sometimes are controversial. US stocks have started coming down a bit, so that's a question of is there the ability to use their stock supplies? But generally speaking, no, supply constraints aren't something that you can just take away quickly.
Okay, we'll leave it there. David Elmes, Warwick Business School, thank you so much.